Welcome back to Smart Money. One asset class that has got a lot of investments lately is gold ETFs. And Ghazal Jain, fund manager, alternative investment at Quantum AMC, is here to tell us how you should invest into gold ETFs and how you should make it a part of your core portfolio as well. Ghazal, before the break, we were talking about how gold ETFs and gold sovereign gold bonds, there are two ways to invest, right, into gold, which is not physical gold. I think a better route, perhaps because of better liquidity and ease of investing, is through the gold ETF route. But let's understand demand trends as well. In the second half of 2023, what can we expect in terms of core gold demand trends, and do you see prices moving higher?
Sure. So the first half of 2023, we saw physical demand was a little subdued because prices were at record highs, and inflation was really taking a toll on discretionary spending. We saw that was kind of subdued. But looking ahead to the second half of 2023, of course, we're starting on an optimistic note. This is the festival and wedding season starting. There are still concerns about, the underwhelming monsoons, impacting rural incomes and hence the demand for physical gold in the second half as well. But there are also, this could be offset by some government spending in the run-up to the general elections next year, which could boost rural incomes. So I would say the outlook for physical demand for the second half is kind of mixed. But if you look at some estimates, there are talks that the entire year physical gold buying this year would be lower by about 10% from last year, closer to 700 tons for the whole year, compared to close to 800 tons that we saw last year.
Okay, so if demand is going to go up, there's a big wedding season coming up. Do you see gold prices as well moving up? I mean, currently, where are we at in terms of gold prices in the MCX market, and what kind of, what's the prognosis now amongst the people that you speak to?
Sure. So, we are bullish, or we think the fundamentals are looking constructive for gold in the medium term, and that is primarily because the monetary tightening that we've seen in the developed world, be it the US or Euro area, is going to come to an end sooner rather than later, and that really fundamentally improves the prospects for gold. That's for sure. But in the interim, like in the very near term, we can expect some consolidation in prices. That's because one or two tactical rate hikes from the Federal Reserve cannot be ruled out, and that would kind of limit the upside in gold prices. So I think now the next few months are a good time or an opportune time for investors to build their allocation because the downside from here doesn't look much. Like you mentioned, limited. Yes, because the higher than average inflation, lower than average growth, the geopolitical tensions, central bank buying, all of this are actually supporting interest in gold. So the downside should not be limited. So a buy on dip strategy should be good.
Should work. And you spoke briefly about central bank buying. Are we seeing a lot of central bank gold buying? Just want to understand what are the numbers looking like now compared to what it was, say, a year ago?
Yeah, so I think last year was a record year for central bank purchases, upwards of 1,000 tons, and an average year for central bank gold buying looks around 500 to 600 tons. So last year was amazing, but that was mostly because the Russia-Ukraine war kind of stirred up risk aversion in the markets, and there was this sense of countries feeling vulnerable to the US weaponizing its currency. So they wanted to diversify away from the US dollar. But this year as well, of course, we don't expect those kind of numbers to come back, like I said. But the first half of the year, up to June, we've seen central banks buy close to 390 tons of gold, which is the highest first half on record. July also, they've bought 55 tons. So looks like this is going to be a second consecutive year of strong central bank buying, and that will be, a soft support for gold prices going forward.
Okay, so since we do believe that there is, of course, this narrative that gold prices are going to move up higher, gold ETFs are a great way to, sort of allocate money in your portfolio, and now is a good time to buy gold. Are gold ETFs, gold mutual funds, a good way to take exposure? We've, of course, discussed that. You folks at Quantum have a gold fund of fund as well. So tell us, somebody wants to start, is it the best way to take, exposure? And if you have, say, 100 rupees, right? I mean, of course, if you're somebody who's young and building your corpus, I assume a large chunk of that will be in equity. But if you had to divide it amongst asset classes, equity, debt, gold, what would the ratio be?
Sure. So, gold is such a unique asset class because it has both pro-cyclical and counter-cyclical drivers. So when economic times are not good, we see investment demand for gold increase. And when economic times are good, we see consumption demand for gold increase. So it's so unique, it's so multifaceted that, we always tell our investors to look at it from a strategic point of view. Another thing is that, investors tend to look at gold in isolation, as in they will try to chase returns and time their entries and exits. We say that, you should actually look at it from a portfolio perspective, because return generation is an added advantage, but gold's true utility is its risk mitigation. Because of its, negative correlation to risk assets like equities, it tends to limit your downside. So from a multi-asset, or an asset allocation perspective, 15 to 20% allocation to gold through efficient vehicles like gold ETFs and gold mutual funds is a good way to approach this, because if you see around those levels, gold can reduce your risk without really impacting your returns. Like you said, equity has to be the major chunk of the portfolio, but a 15 to 20% allocation to gold should be a good way to approach it.
Okay, so all of you young folks who are perhaps beginning your career or beginning your wealth creation journey, a 15 to 20% allocation to gold is always a prudent strategy. What is the role of gold in multi-asset portfolios?
So those who do not want to say, open a demat account and invest in gold ETFs directly, there are two ways to go about it in the mutual fund route. There are gold fund of funds, like I mentioned, which invest in the gold ETF on your behalf, which are more convenient. You can just, open a folio like you open in any mutual fund and start investing. And and what's better is that you can do it in a staggered way. The other option is multi-asset funds. They also give an exposure to equities, fixed income, and gold. And their gold allocation is through gold ETFs. So if you're looking for an asset allocation solution, you can look at multi-asset funds, which will take that exposure for you through efficient vehicles like gold ETFs.
Okay, and in gold, in sovereign gold bonds, I just wanted to ask you, because we get a lot of queries on this, right? This 8-year lock-in, what is the, post 8 years, what is the kind of, say, okay, let's compare taxation for the entire thing, right? Gold ETFs versus sovereign gold bonds. How is the taxation part handled? Say, what is better between ETFs and SGBs?
Sure. So on the taxation front, SGBs score above gold ETFs currently, and this has been actually a recent phenomena because recently when the taxation rules for debt mutual funds were changed, gold ETFs were a collateral damage to that, and they also lost the indexation benefit for long-term capital gains in the process. And on the other hand, sovereign gold bonds, if held till maturity, the capital gains are tax-free. So from a taxation perspective, SGBs will score over gold ETFs, but I think I would like to tell investors that taxation should not be the sole criteria for choosing an investment avenue. We Indians tend to do that, but price efficiency can be a function of not only taxation but also liquidity, because liquidity comes with its costs as well. So I think that is something that ETFs can provide them, and they should take a sensible, all-rounded and
absolutely. And I think also as you grow older, perhaps not for the younger generation, as you grow older, when you're 35, 40, it's always better to have a lot of your money in liquid assets, right? So if gold ETFs are something that you can withdraw immediately, there is no exit load, rather than with SGBs, which has such a long duration holding period, you prefer
also,
gold ETFs.
Sonia, imagine if there's an 8-year lock-in, okay, you get into gold SGBs right now. Imagine 8 years later the prices are down, so you did not have an exit option before to book your profits, say at year 5 or year 4 or year 6. So 8 years down the line, you never know, prices could be down, and you would be forced to be there would be no capital gains for them to be taxed. So this is something because we're so focused on the taxation that we kind of miss out on these nuances. Which
and I think that's the same thing with equities as well, right? I mean, equities are taxed, but at the end of the day, the amount of returns that you make far outweigh the kind of taxation that you'd have to pay in terms of long-term capital gains.
Yes.
Okay, Ghazal, it was great speaking with you. Thank you so much for joining us. I didn't realize how half an hour passed. Learned so much on the gold ETF space and, of course, what's happening. Thanks for being with us on the channel.
Thank you, Sonia.
Okay, well, with that, it's a wrap on this edition of Smart Money. Keep writing to us about the topics you'd want to see, about the discussions you'd want us to have, and we'll be glad to take it up on our show. Thanks a lot for watching. Have a great weekend.